Okay, so good afternoon, everyone. This is Avijit Ghosh, and I just welcome you all to my classes, AG classes. Um, Today's discussion will be on a chapter from financial management. But before discussing that chapter, I would request to all of you, if you think that this video is very much useful to you, then please do subscribe the channel and don't forget to leave comments and your likes. So let's start the video. As I told you, the chapters today I will discuss, that is cost of capital from financial management. So as you see, the chapter is cost of capital. So here in cost of capital you find two terms, cost and capital. We all understand the meaning of capital. Capital is basically the finance, the money, what a company requires to run its business. Now the question is, where from the company, especially the public limited company, they get their capital? There are various sources. They issue equity shares, they issue preference shares, debentures, take loan from bank, they take deposit from public. So several sources are there from where a company, especially a public company, it arranges its capital. Now those people who supply capital to the company, that is the investors, definitely they have expectation from the company. When they are giving money to the company, they keep some expectation from the company. So what the company do? The company pays a certain amount as return to those suppliers of capital. And the amount which is paid by the company as return to the investors, that is basically cost of that capital supplied by the investors. So in this chapter, cost of capital, we will be learning basically how to compute this cost of various sources. As I told you that there are several sources. So in this chapter, we will learn how to compute that cost of each and every sources. Okay, so now we will see the definition of cost of capital. If we read the definition is like this: cost of capital is the rate of return expected by the investors who supply capital to the company. The investors are supplying capital, and whatever return they expecting from the company, that is cost of capital. In the next slide, I will show you what are the various sources of capital. As you can see, in general, there are four sources. Debt capital, that includes debentures or long-term loans, pref capital, equity capital, and return earning. Return earning means basically the reserve, okay, part of profit which a company keep aside for future losses. That is return earning. So these are the basic four sources for a company. Now we have to learn for each source the cost of capital. We have to calculate or we have to learn cost of debt capital, cost of pref, cost of equity, and cost of return earning. So these are the forces, and we have to learn the cost of each and every sources. Now in this chapter we have to do two types of sums. I will show you. One is computation of specific source of capital. As I told you, there are four sources. So we have to know how to compute cost of debt capital, then cost of pref, then cost of equity, and then cost of return earning. Apart from this, another type of sums we have to learn here in this chapter, that is computation of weighted average cost of capital. After calculating each source cost, we have to calculate the weighted average cost. Okay, so these two types of sums are basically important from this chapter. One is calculation of specific cost, and another is calculation of weighted average cost. Okay, now what we will do in the coming slides, we will try to understand how to calculate the cost of each source, and thereafter we will learn how to calculate the weighted average cost of capital when we have cost of each source. So the first source, as I told you, cost of debt capital. So how to calculate the cost of a debt capital? The debt capital basically it includes debentures and long-term loans. So debt can be of two types. One is irredeemable debt, another is redeemable debt. Irredeemable debt means The debt which is not repayable. Company takes money from the investors and company do not refund the money. That is irredeemable, which is not repayable. And when you talk about redeemable debt, company takes money and after a certain period of time, company refunds the money. That is redeemable debt. Now, in case of irredeemable debt, there are two situations. One is cost before tax, another is cost after tax. Before tax cost, how to calculate for a irredeemable debt? Ki equals to I by P. I is basically annual interest and P is the net selling price. That means when a company sells the debentures, suppose the debenture price, the issue price is 100 and company has to incur 5 rupees as flotation cost. Then what is the net selling price? 100 minus 5, 95. I mean to say here P will indicate ultimately the collection made by a company by issue of debentures. If there is flotation cost, if there is discount on issue, all those things have to be deducted to get the net amount. So basically debentures can be issued in three ways, either at par or at premium or at discount. When it is at par, then P is 100. When it is at premium, then 110 it can be. When it is at discount, it can be 95, 90. So you have to deduct the discount amount. Okay, that is before tax cost, I by P. And how to calculate after tax cost for an irredeemable debt? KD equals to I by P into 1 minus T. The formula will remain same. Before tax it was I by P, but after tax you have to multiply I by P with 1 minus T. Why? Because when a company pays interest to the debt holders, then that interest is debited to profit and loss account. So ultimately this interest helps to save tax amount, okay, which is also known as tax shield. So that's why in case of debt, you will find whatever be the before tax cost, after tax cost will reduce, decrease. If before tax cost is 20% and if there is tax rate of 50%, then after tax cost will be 10%. Always, because the tax shield is there. So after tax cost, how to calculate for a irredeemable debt? I by P into 1 minus T. Okay, fine. So for irredeemable, two things we have done, before tax and after tax. Now come to redeemable debt. As I told you, redeemable debt is the debt which is repayable after a certain period of time, maybe after 6 years, 8 years or 10 years. So again, for redeemable debt also, we have to calculate the cost, before tax cost and after tax cost. Before tax cost, Ki, I plus R minus P by N divided by R plus P by 2. I is interest, R is actually the redemption value. That is the amount company will repay after 8 years or after 10 years. That means at the time of redemptions, the amount which a company will pay, that is the redemption value R. P is the net selling price. N is the number of years, that is the number of years after which the company will repay the amount. So this way we get the before tax cost. And when it is after tax, the formula will remain same. The only thing is that with I you have to multiply 1 minus T. Rest of the thing will remain same. As you see, I into 1 minus T plus R minus P by N divided by R plus P by 2. So this is cost of redeemable debt before tax as well as after tax. If you look at the formula carefully, both the formula almost same. Just in after tax there is tax shield, that's why I into 1 minus T, but in before tax that is not there. So this way the cost of debt capital is basically calculated. Okay. Now we will do a sums based on this cost of debt capital. One thing I must say here, when you will be trying to solve sums based on cost of debt capital, first you have to read the sums carefully and you have to identify whether the debt capital or the debentures, whatever there is in the sums, whether it is irredeemable or redeemable, that you have to identify first. And accordingly you will apply the formulas, which formula you will apply to calculate the cost. Okay, just I'm taking the next slide. Look at this. This is sums on cost of debt capital. So Bina Limited has issued 12% debentures of face value 100. So company Bina Limited is issuing 12% debentures. Face value is 100. and in total company issued 10 lakhs debentures. For 10 lakh rupees, 10 lakhs. The debenture is expected to be sold at 5% discount. It means face value is 100, but when the company will issue the debentures, company will be giving 5% discount. That is 5 rupees discount per debenture. So the net proceed 100 minus 5, 95, and it will also involve flotation cost. So again you have to deduct 5. So by issuing one debenture, the ultimate collection made by the company is 100 minus 5 minus 5, that is 90 rupees. Debentures are redeemable at a premium of 5%. That means redemption value will be 100 is the face value, and at the time of redemption, company will pay 5% extra. So 100 plus 5, redemption value becomes 105. And it will be repayable after 10 years, so N has to be 10. And the tax rate is here 50%. Okay, so after reading these sums, you identified it's a redeemable debenture, as because in the sums it's clearly given that it would be repayable after 5 years. Okay, so sorry, it would be repayable after 10 years. So this is a redeemable debenture. Now the formula to calculate cost of redeemable debenture is KD equals to I into 1 minus T plus R minus P by N divided by R plus P by 2. I is very simple, 12, because a debenture face value is 100, so 100 into 12%, interest for each debenture is 12. 1 minus tax rate, as you can see, tax rate is 50%, so 1 minus 0.5. Redemption value, that is the value payable at the time of redemption. 100 was the face value and 5% premium was payable on redemption, so redemption value will be 105. Net selling price is 90, ultimate the collected amount divided by N is 10, that is the debentures is repayable after 10 years. So solving this formula, we get finally 7.69%. So this way, the cost of redeemable debt capital is calculated. So first source we have completed, that cost of debt capital. The second source is pref capital. So see how to calculate cost of preference capital. Come to the next slide. This is cost of preference capital. Again, for preference shares, these two types of preference shares are there: redeemable and redeemable. Irredeemable means company will take money by issuing preference shares, but the company will not refund any money. That is the redeemable. And redeemable means after a certain period of time, the company will refund the money. That is redeemable. In case of preference shares, there is no question of income tax. Income tax has got no impact, as we saw in case of debentures. In case of debentures, since interest is a expense to profit and loss, that would have saved tax. But in case of preference shares, that type of concept is not there, because preference shareholders gets dividend from the company, and dividend is basically appropriation of profit. It's not a charge against profit. So in calculating cost of preference capital, the income tax has got no impact. Okay, but there is the concept of dividend tax. Though in practical, right now, if you ask me, is there any dividend tax in India? There is no dividend tax right now. But previously it was there, that whatever amount the company pays as dividend, on that dividend amount, a certain percentage dividend tax has to be given to the government. So company doesn't pay only dividend to the pref shareholders. Company pays dividend to the pref shareholders, and along with that, the dividend tax to the government. So when we consider the cost of preference capital, then we have to consider both the things: the dividend paid by the company to the pref shareholders and the dividend tax paid by the company to the government. So two situations we have discussed here: when there is no dividend tax and when there is dividend tax. When there is no dividend tax, KP equals to D by P. D is equals to dividend, P equals to net selling price by issue of preference shares. And when there is dividend tax, D by P into 1 plus dt. Notable point, in case of debentures, we did 1 minus T, because that would save your tax. Okay, that's why 1 minus T was the formula. But herein, dividend tax is paid in addition to the dividend. That's why both are included, both are added up to get the cost of preference capital. That's why D by P into 1 plus dt we do in case of preference shares. So for irredeemable, this is the two situations: no dividend tax and with dividend tax. And when the preference shares are redeemable, then also two situations are there: no dividend tax and with dividend tax. When there is no dividend tax, d plus r minus p by n divided by r plus p by 2. It's very simple. It's similar to the cost of debt capital, redeemable debt. There it was I plus r minus p by n. Here it is b plus r minus p by n. Because for a debt, interest is the cost, and for a preference, dividend is basically the cost. With dividend tax, as you can see, d into 1 plus dt. So 1 plus dt is added. Rest of the thing will remain same for a preference shares which is having dividend tax. So these are the two ways by which we can calculate the cost of preference capital. Now definitely we will do a sums. Okay. Again, I must say that when you will be solving a sums, first you have to identify by reading the sums whether the preference shares mentioned in the sums is the redeemable pref share or redeemable pref shares, and accordingly you will apply the formula. So let's come to the next slide. So this is a sums based on cost of preference shares. P Limited issued rupees 10 lakh 11% pref share of 100 each. So one pref share is 100 rupees and company pays 11% dividend. That means for each pref share, company will pay 11 rupees dividend. Flotation cost is 2% on issue price, and the pref share will be redeemed at a premium of 5% after 5 years. That means for 100 rupees preference shares, when the company will issue, then the company will collect 98 rupees because 2% flotation cost is there. So for each preference, company will get 98 rupees. That is P equals to 98. Redeemable at a premium of 5%. That means for 100 rupees is the face value. So redemption value will be 105 and N is 5 years. The company is the tax rate applicable to the company is 30%. As I told you, income tax rate has got no impact in calculating cost of preference capital, but dividend tax has to be taken into consideration, which is 10%. Calculate the cost of capital. So it's easily identifiable. Okay, here the preference is redeemable, and we will use the formula for redeemable pref share. And Kp is equals to d into 1 plus dt plus r minus p by n divided by r plus p by 2. So d is basically dividend per share, that is 11. 1 plus dt, dt is the dividend tax rate. As you can see, 10% is 0.1 plus redemption value is 105. Net selling price is 98 and number of years is 5. So applying or solving this formula, finally we get cost of preference equals to 13.3%. So this is the way we calculate cost of preference capital. So two sources we have completed: cost of debt capital, cost of pref capital. Next is cost of equity capital. Now for cost of equity capital, we will see 5 methods are there. Okay, almost methods are very similar. The little bit differences are there, but still we have to know the 5 methods for calculating cost of equity capital. The first method is dividend price method. In this method, to calculate cost of equity, we consider dividend. So very simple formula: K equals D by P. D is the dividend and P is the net selling price. But for P, in case of equity, we have to see if it is a new equity, new issue of equity, then P is the net selling price. But it is if it is already existing equity, which is already being sold in the secondary market, then we have to consider the current market price. So by reading the sums, you have to understand whether it's a new issue or whether it's an existing issue. In case of new issue, you have to take P as net selling price, and in case of an existing issue, you have to take P as current market price. So this is dividend price method. The second method is dividend growth model. Very simple, similar to almost the previous method. The only thing you have to add here, that is growth rate. So here Ke equals to cost of equity equals to D by P plus G. D by P is the same as I discussed in the first method. G is the growth rate. Okay, so growth rate, it can be given in the sums, or you can calculate growth rate by multiplying B into R. B is the retention ratio and R is the return on equity. Sometimes in our sums, we may have to do that. If G is not given directly, we have to calculate G like multiplying B and into R, return on equity. But in most of the cases, you will find the growth rate ratio is given. So in that case, K equals to is very simple, D by P plus G. Okay. Next, third method, come to the next slide, earning price ratio method. Previously in the two methods, we consider dividend. But in this two methods, that is third and fourth method, we will consider earning. One is earning price ratio method, that is E by P. Earning by P. P is the net selling price or current market price, as the cases may be. If it is new issue, P is the net selling price. If it is existing issue, P is current market price. And when we talk about earning growth model, that is the fourth method, the same thing, it's similar to the third method, like E by P, the added thing is plus G. So growth rate has to be added here. And the fifth method is CAPM model, which is also known as capital asset pricing model. Here in cost of equity equals to RF, that is risk-free return. Okay, RM is the return of market, RF is also risk-free return, and beta is the coefficient. That is the risk of a particular stock, whether the stock is aggressive or defensive, or whether the stock is at par with the market. That is measured with this beta. So risk-free return means you invest somewhere and you get a certain return. That is risk-free return. Suppose if I invest in fixed deposit in a bank, whatever return I get there from, that is risk-free return, because I have got no risk. Whatever be the market conditions, the rate of return is fixed. Return of market, that is the return which a market is giving actually right now. That is return of market, the actual scenario. So RM minus RF, return of market minus risk-free return. Balance of that has to be multiplied with the beta. Beta basically measures the risk of a particular stock. And then plus RF, we will get the cost of equity. So this is actually CAPM model or capital asset pricing model. So in case of equity shares, we have seen 5 methods: dividend price method, dividend price growth method, earning price method, and earning growth model. And the last one is CAPM, that is capital asset pricing model method. Okay, now we will be solving a sums based on cost of equity capital. So now this question often comes from the students, that while calculating cost of equity capital, how to decide which methods you have to apply. Because in most of the cases you will find they will not mention any methods, that you apply this method to calculate cost of equity. Then how we will understand which methods to apply? Actually, by reading the sums, by the information of the sums, you have to decide which method is suitable here. As you see, come to this sums. Here the current market price of a share in 2015 is 300. For equity shares, current market price is 300 in 2015. Last year in 2014, it paid a dividend of 30, which was declared in 2015. So the dividend was declared in 30. The amount was paid in 14, but the current market price at the end of 2015 is given. And it has a steady growth rate of 4%, find the cost of capital. So if I analyze the information of this sums, dividend is given, but the current dividend is not given. Dividend of 2015 is not given. Dividend declared in 2013 was 30, but market price is given for 2015. So if we analyze the information of the sums, we find here dividend is given, current market price is given, as well as the growth rate is given. So automatically the sense comes D by P plus G. D is the dividend per share, expected dividend per share, P is the current market price, and G, growth rate, is given. Now while calculating D, you have to be a bit cautious here. Why? Because the D given here, that is in the year 2013, which is of 30 rupees. But the thing is that the current market price is given for 2015. 30 was the dividend in the year 2013. So what you have to do, you have to calculate the dividend expected in 2015. So there was in between 2013 and 15, there was 2 years. So 2013 it was 30 plus 4%, you will get the dividend at the end of 2014, again 4% plus, then you will get the dividend at the end of 2015. That's why you see in the formula I have used K equals to D by P plus G, where D, just you see the calculations, 30 into 1.04 into 1.04, or you could do 30 into 1.04 square. That means from 2013 it was 30, then plus 4%, we got the dividend in 2014, again plus 4%, then we got the dividend at the end of 2015. And thus we got the dividend price is 32.45. P is the net selling price or current market price. Here current market price is given, that we have taken 300. Putting the values in the formula, we get K equals to 14.82%. So this is the way you have to calculate cost of equity capital. So we have already completed three sources. The first one was debt, second one was pref, and the third one cost of equity. Fine. One more source is there. That is retained earning. Retained earning, as I told you, is basically what? Retained earning is a reserve. Actually, every year, whatever profit company makes, a part of the profit is kept aside, is reserve. So that reserve is basically used in a company as internal capital. So what is the cost of that reserve or retained earning? The cost of retained earning, we can say cost of equity and cost of retained earning. These two are same basically. If there is any tax or brokerage cost, then cost of retained earning will decrease bit than cost of equity. So the formula for cost of retained earning here equals to KE. KE is cost of equity into 1 minus T into 1 minus B. If there is tax rate, if there is brokerage cost, then KE will be multiplied by 1 minus T into 1 minus B. But if you assume there is no tax, no brokerage cost, then KR and KE is same. Okay, so you just remember one formula for cost of retained earning. KR equals to KE into 1 minus T into 1 minus B. If there is T and B, then you will consider. If there is no T and B in the sums, then you will not consider. Simply you will consider KR equals to P. Okay, so that is the cost of retained earning. So four individual sources we have completed: debt, pref, equity, and retained earnings. So that is a part of type 1 sums. As I told you, two types of sums are basically important from this chapter, cost of capital. In the very first type, each sources cost will be asked, like cost of equity, cost of preference, cost of debt, and cost of retained earning. And how to do that, we have completed. Now we will move to the next slide, and there we will see how to calculate the cost of weighted average cost of capital. See, weighted average cost of capital, you have got all cost of capital. I mean to say there are four sources, and for each source the cost is available to you. Now from all the four sources and all the cost of capital, you have to compute an average cost of capital. So how to do that? KO equals to, you have to consider cost of equity and weight of equity, cost of debt, weight of debt, cost of preference, weight of preference, cost of retained earning, and weight of retained earning. Now the question is, what is weight? Cost we understand very well. Cost we have already learned how to calculate cost of each source. That is the cost. Applying those formula, we have got the cost. Now weight, what does weight means? Weight, again, weight can be based on book value or weight can be based on market value. First I will discuss what is weight on book value. If I consider a company has in total capital of 10 lakh rupees, and out of this 10 lakh, 4 lakh is debt capital, 3 lakh is pref capital, 2 lakh is equity capital, 1 lakh is retained earning. 4, 3, 2, 1. So weight of debt will be 4 by 10, that is 0.4. Weight of pref will be 3 by 10, that is 0.3. Weight of equity will be 2 by 10, that is 0.2, and weight of retained earnings will be 1 by 10, that is 0.1. So individual weight divided by total capital of the company, you will get the weight of that particular source. So when weight is considered on book value, this way the weight is calculated. So I will be discussing a sums based on book value weight. Okay, so come to the next slide. Look at this weighted average cost on book value. Here I have taken four sources, as you can see in the sums left hand side: equity, preference, debenture, return. Four sources I have taken. The amount is 7, 280, 350, and 70. In total, 14 lakhs capital is there in the company. After tax cost is given. You don't have to put efforts to calculate each heads of cost. The cost is given here. So solution, I have written the sources, four sources. Individual amount I have written. And as you can see, the total cost of capital, total capital is 14 lakh. And weight, how did I calculate the weight? 14 lakh is the total capital. So the first source is equity, which is 7 lakh. So 7 lakh by 14 lakh, it becomes 0.5. 280 by 14, 0.2. 350 by 14, 0.25. So this way I calculated the weight. In the next column, cost is given in the sums 0.16, 0.12, 0.10 and 0.16. Now weight and cost, if we multiply, we will get weighted cost. 0.5 into 0.16, 0.080. This way, weight and cost has been multiplied for each sources, and finally, adding all the weighted costs, we get 0.137. So to convert it in percentage into 100, we get 13.7%. This is very simple. Just you have to understand, here we have considered the weight based on book value. But another way is there, wherein we have to calculate the weighted average cost taking the weight as market value. Okay, you have to consider market value as weight. So let's do a sums based on market value. See, this is the problem which is based on market value cost. Sources I have taken 4: equity, preference, debenture and retained earnings. Book value is there, it's 3 lakh, 150, 120 and 30,000. Market value is given for equity, but the notable point, for retained earnings, no market value has been assigned. Preference has its own market value, that is 120, debentures has its own market value, 120. So market value is available for preference, debenture and equity. Problem is that for retained earning there is no specific market value. So what to do? Actually, this 3,80,000, this market value is for equity shareholders. And equity shareholders include equity capital as well as retained earnings. So this 3,80,000 needs to be apportioned. This market value of 380 needs to be apportioned between equity as well as between retained earnings. So in between equity and retained earnings, this market value of 3,80,000 has to be apportioned. How to do that? Very simple. 3,80,000 is the total market value. So book value of equity and retained earnings is 3,30,000. So in total book value is 3 lakh plus 30, 330. So market value for equity will be 3,80,000 into 3 lakh by 330. You will get the market value of equity. And market value of retained earning, in the last line you see 3,80,000 into 30 by 330. You will get the market value of retained earning, which is 34,546. And for preference and debentures, the market value is given that I have taken. So adding up all the market value, I get 6,20,000. Weight is very simple. Equity's market value is 3,45,454. That divided by 6,20,000, you will get the weight 0.56. 1,20,000 by 620. For preference 0.19. Debentures also same, and for retained earning it's 0.06. Next column is cost, which is given in the sums 15, 12, 10, 14. Now cost and weight multiplied, we get the weighted cost, and adding up all the weighted cost, we get finally 0.1334. Into 100, we get it in percentage 13.34%. Okay, so this way the cost of weighted average cost of capital is calculated based on market value. So these are the entire content you can see in cost of capital, and especially for BCom level, if you go through all the slides, I think you will be comfortable in this chapter. So thank you all for watching the video, and one thing again I say, please don't forget to subscribe the video if you really feel that this video is very much useful. Thank you all.